The U.S. Federal Reserve has decided to cut interest rates again. Officially, this is called supporting growth. Unofficially, it looks a bit like a barber trimming hair while accidentally cutting the oxygen tube. Snip, snip, oops. Because here's the strange part. When America cuts rates, the economy is supposed to feel better. But the dollar, America's most powerful global weapon, starts to feel weaker. Trade reacts, markets shift, countries quietly take notes. So today we're asking a simple question. Why does lowering interest rates make the US dollar lose its grip on the world? And more importantly, what does that mean for trade, geopolitics, and your wallet? In theory, interest rates are simple. High rates mean borrowing is expensive. Low rates mean borrowing is cheap. So when the economy slows, central banks cut rates to encourage spending, investing, and borrowing. Businesses expand. Consumers spend. Everyone feels slightly more optimistic. On paper, it's beautiful. Like a PowerPoint slide with arrows going up and nobody asking questions. But here's the problem. The US dollar is not just a local currency. It's the world's reserve currency, which means the dollar doesn't just serve Americans, it serves everyone else too. And when America cuts rates, the rest of the world reacts very differently. Let's talk about foreign money. Global investors don't wake up thinking, how can I help the US economy today? They wake up thinking, where can my money earn the most? Safely. When US interest rates are high, the answer is easy. America. Strong institutions, deep markets, decent returns. Money flows in. Demand for dollars rises. The dollar strengthens. But when the Fed cuts rates, America becomes less attractive. Suddenly investors look around. Japan? Europe? Emerging markets? Anywhere offering better yields? Money doesn't protest. It doesn't debate. It quietly packs its bags. Capital flight doesn't look dramatic. It looks polite, professional, spreadsheet approved. And every dollar that leaves is one less reason to stay loyal. Now, some people say, a weaker dollar is good for exports. And yes, technically, US goods become cheaper overseas. But that's only half the story. Trade is not just about price, it's about leverage. When your currency dominates global trade, you get to set the rules. Invoices are written in your money. Contracts are priced in your money. Debts are owed in your money. That's power. But when the dollar weakens, that bargaining power starts to slip. Countries begin asking uncomfortable questions. Why are we settling everything in dollars? Why are we exposed to US monetary policy? Why are our trade risks tied to Washington's decisions? These questions don't make headlines, they make contingency plans. No one is announcing, "We are abandoning the dollar." That would be dramatic. Instead, countries do something far more effective. They quietly diversify. Bilateral trade deals, local currency settlements, regional payment systems. China pushes yuan settlements. Russia avoids dollars where possible. Middle Eastern energy deals experiment with alternatives. Not because the dollar is collapsing, but because relying on one currency feels risky. Especially when that currency's value changes every time the Fed sneezes. De-dollarization is not a revolution. It's a renovation. Slow, quiet, very intentional. Here's where things get uncomfortable. When America cuts rates, it's making a domestic decision. But the consequences are global. A weaker dollar doesn't show up clearly in GDP, it shows up in decisions. Sanctions still hurt, but they don't freeze the system. Trade pressure still works, but it works slower. And even allies start asking a quiet question. What's our backup plan? History shows us something important. Major shifts in global power are often preceded by currency shifts, not overnight collapses, but long, slow erosion. Rome didn't fall because of one bad policy. Britain didn't lose dominance in 1 year. Power fades quietly, until suddenly everyone notices. You might be confused by now, so let's change perspective. Think like a foreign exporter. You run a factory outside the United States. You sell goods to America. For years, life was simple. You ship products, you get paid in US dollars, you keep those dollars. Why? Because dollars were safe, they paid good interest, and America was predictable. Selling to the US wasn't just business, it was security. Then Trump arrives. America says, if you want access to our market, there may be tariffs. Rules may change. Pressure is real. You don't like it, but you accept it. Because America is still your biggest customer. And the dollar still matters. So you stay. Then interest rates get cut. You're still paid in dollars, but now those dollars earn less. Your US bank pays less interest. Your US bonds pay less return. At the same time, tariffs stay. Policy feels more political. Decisions feel faster and harder. So you ask a very simple question: why am I taking more pressure for less reward? And this is where behavior changes. You don't leave the US market, but you stop depending on it. You quietly adjust. You diversify. You prepare backups, not to rebel, to survive. Before, exporters thought, if we lose dollar access, we're finished. Now they think, it will hurt, but we'll manage. And that single thought changes everything. As exporters adjust financially, supply chains adjust quietly. Production spreads, routes diversify, risk gets shared. Nothing breaks, nothing disappears, but leverage thins. And leverage, once diluted, is very hard to concentrate again. At this point, a fair question appears. If tariffs reduce dependence on the dollar and rate cuts make the dollar less attractive, why push both? Trump's answer is simple. That power was already being wasted. Trump does not treat the dollar as a trophy. He treats it as a tool. For decades, that tool made imports cheap, factories offshore, and Wall Street comfortable. America stayed rich, but hollow. So Trump flips the priority. Bring production back, protect domestic jobs, reduce foreign dependence. Tariffs apply pressure outward. Rate cuts apply relief inward. That's the package. And Trump is willing to pay the global price for that domestic relief. Yes, the dollar weakens slightly, and Trump accepts that, because a strong dollar that supports everyone else's factories is not strength. It's outsourcing with confidence. Now, let's bring this home. A weaker dollar sounds abstract until it shows up in your life. Imported goods cost more. Travel becomes more expensive. Foreign investments behave differently. Inflation becomes harder to control, not because prices explode, but because stability erodes. Nothing breaks. Things just stop feeling predictable, and people hate unpredictability more than bad news. So, is this the end of the US dollar? No, not even close. The dollar is still dominant, still trusted, still deeply embedded in global systems. Dominance is not invincibility. Every rate cut trades short-term comfort for long-term influence. It's a choice, sometimes necessary, sometimes risky, always consequential. The real question isn't, will the dollar collapse? The real question is, how many small cuts can the dollar absorb before the grip loosens just enough for the world to slip away? Because power doesn't disappear in crashes. It fades in footnotes, in spreadsheets, in quiet decisions made elsewhere. And by the time it becomes obvious, the haircut is already finished. Thank you for watching Pastcast, where the past echoes through today. If you enjoyed the satire, scrolls, and scandals, like, subscribe, and ring the bell before the next empire falls.